The Congressional Budget Office is projecting higher inflation and unemployment this year, with slowing economic growth ahead. Joining us right now to discuss it is CBO Director Phill Swagel. And Phil, thanks for coming in today.
Yeah, Becky, thanks so much. Thanks for having me.
So the new numbers, the new estimates, take into account several things. One is population growth because of immigration. You're anticipating that it's going to be significantly lower. The other is the one big beautiful bill, what the costs are associated with that, and I guess the costs are higher. And that's the two impacts that we have on these numbers.
No, that's right. And we have the bill, the reconciliation bill, is boosting the economy, and immigration is slowing it down. And then the effects of the tariff are both raising inflation and slowing down the economy, both businesses and households facing the drag from the tariffs.
I mean, I think about trying to compute all of these numbers with the many, many moving pieces that you have. It's a pretty complex situation. And I would imagine it changes on a pretty daily basis. But let's focus on population growth first, because that probably plays into the jobs numbers that we've been getting. And that's kind of front and center for what the Fed is going to be deciding this week. What do you see with those population numbers?
No, that's right. And the challenge for the Fed is that we have both labor demand going down as the economy is weakening, but labor supply is falling dramatically. And we have our population numbers that you mentioned look to be several 100,000 fewer each year over the next 10 years, and something like 1 million fewer this year alone. And that's from the change both in the law that was passed on July 4th, provides more money for enforcement and the wall and things like that. But since January 20th, the administration has put in a series of administrative measures that have really stopped people from coming in across the border in the way that they were the previous 4 years. And, look, there's lots of issues around that. But for the economy, it means fewer people and fewer workers.
Does that suggest that the jobs market is healthier than we may anticipate, given some of these reads? Because the unemployment rate's still 4.3%.
Yeah, that's the challenge, is that both labor supply and labor demand are falling. So the break even for the monthly jobs number has got to be much lower. It's got to be much lower. Okay. But still, we see lots of signs that the economy is weakening, and that that obviously the Fed is seeing that as well.
Yeah, I'm trying to square that up with what we just heard from Ed Yardeni. He looks at it and says, yeah, maybe we'll get a 25 basis point cut, but he thinks that we're basically at neutral levels now. He's a pretty straight down the middle guy who just looks at markets and by the way, thinks the markets are going to continue to grow for the next several years pretty effectively. Yeah, no, I mean, Ed is really interesting because he sees the complexity in this, and that's one of the challenges for us. And you talked about how the economy is changing minute by minute, and policies are changing, and we see the tariffs changing day by day. There's a lot of uncertainty in the economy. Yeah, how do you even put the tariffs into this? What are your assumptions?
So we essentially follow what the administration is doing really day by day, and we have a team at CBO that does the modeling of this. Whatever they do, we look at it, we wait until the dollars hit the Treasury statement, and then we assume that those policies will continue out forever.
What happens if a judge rules that these tariffs, or at least many of them, are illegal?
The Supreme Court.
The Supreme Court, right. This is now in front of the Supreme Court. It's one of the key uncertainties in the economy. That is
Have
both.
You run the
what
numbers,
would you do? You don't count them anyway, right?
No, we do. So we
But
count,
you don't count it in terms of deficit reduction.
No, we do. So
do.
we have the tariffs that the president has put in place since January 20th. We have those reducing the deficit by $4 trillion over the next 10 years.
Wow.
So it's $3.3 trillion of revenue, and then $700 billion of averted debt costs. So that would be a big reversal in terms of the deficit. On the other hand, it'd be lower inflation and probably higher business investment, higher consumer spending.
So net, you still came up with that the tariffs were going to increase it. Oh, no, it was the OBBB was going to increase the deficit by $4 trillion.
That's right. It's by 3.4 trillion plus the
debt service cost.
Did you offset it with the tariff stuff?
No, we will. In our future budget updates, we will do that arithmetic, putting everything together in the same place. For the score of the bill, we only look within the four corners of the bill, and that's where the tariffs are separate.
The bill, you said, would increase the deficit by $3.4 trillion from 2024 to 34, but then you say the debt service costs added up to 4.1.
The additional.
With the additional. Adds it up to 4.1
exactly.
trillion. That assumes that interest rates are at what level? Because that's a big factor in all of this, too.
No, that's a key. So we have, for that cost estimate of the bill, we were using our economic assumptions that were made on January 17th. And that's the budget rules, right? That's what Congress tells us to do. We will be looking at it again now and see, what is the trajectory of interest rates?
The president wants it 300 basis points lower.
Yeah, I mean, we do expect the Fed to cut interest rates. We have 75 basis points of cuts between now and the end of January. So we do expect that to happen. There's just kind of so much going on in the economy, it's hard to know where it will end up.
Do you make judgment calls as to whether tariffs are good and for the economy? Do you make judgment calls about one big beautiful bill? Like, how do you come down on it?
Yeah. So what I tell members of Congress is that they get our analysis and not our opinion. So I will tell them, here's what it does to the economy: tariffs, higher inflation, higher revenue, slower growth. Whether that's good or bad is up to the Congress, to the president, now to the Supreme Court. So we're looking at just the budget and economic effects, and not whether it's the right thing. Have
you run the numbers as to what would happen? Like, do you run different scenarios if the Supreme Court were to overturn those tariffs? Like,
we haven't done that yet. It's
really
implicit. We haven't said, well, if the Supreme Court does that, what would happen to the economy? I mean, it's implicit in the $4 trillion of revenue, $4 trillion of revenue plus net interest costs. That would reverse over the next 10 years.
So would inflation?
Inflation would be lower. I mean, this is a 3.3 trillion.
But you literally haven't run these numbers, or you don't want to tell them because you don't.
No.
Yeah.
In our economic assumptions, we look at the law as it is now, and that's what Congress has told us to do. To say, tell us the baseline, assuming current law. Current law plus current policy has the tariffs. If those are reversed, we will certainly do that arithmetic, and it's going to, again, it's a mix, right? Because it's less revenue, higher deficit. But it's like a big tax cut on businesses and households.
In terms of the inflation numbers that have surprised so many people on Wall Street, has it come as a surprise to you? Or how often do you tweak those numbers?
We do. So we update our forecast just a couple times a year, generally 3 times a year. That's what we did just last Friday.
Yeah.
Inflation since January has come in a bit higher than we expected.
Oh, it has?
It has.
So it's higher than you expected?
It's higher than we expected at the end. That's right. It's lower than what Wall Street expected, but higher than what we expected. And it's probably the tariffs, right? The economy has been weakening over the course of the year. And you'd expect that to lower inflation, but the tariffs have probably been pushing up inflation. Not by a lot, but by enough to show up in the
Where
numbers.
else are your assumptions far different than Wall Street?
Now that's a good question. The biggest change would be that by law we assume current law, right? So we don't assume future changes in fiscal policy. And Wall Street naturally does.
Right.
So at some point, there has to be either lower spending or higher taxes. And we don't assume that because Congress wants us to tell them what's the situation under current law.